All right, good afternoon, everyone. Good afternoon, my construction management 400, CMG 400 students. This is our third week, but our second session. We missed a session in the middle. This evening, we're going to talk about, we'll show a practical demonstration of the accounting cycle. I will use some transactions, analyze those transactions, convert them into journal entries, and post those journals onto the ledgers, corresponding ledger accounts. Then we'll do ledger balancing and transfer those balances to a trial balance. Once we have the trial balance, we'll be ready to prepare basic financial statements. Our financial statements would include an income statement and a balance sheet and a retained earnings statement. But at the end of the course, we should be able to prepare a cash flow statement as well. Because for engineers, a cash flow statement is as important as any other statement. So remember, this is accounting for construction projects. We're going to use accounting information to make our projects more efficient, more profitable, more sustainable, more user-friendly, because we live in a competitive world and our work is being analyzed and scrutinized by our customers, not just by our customers, but by many agencies like city councils, environmental reporting groups, and many other interest groups. I would like to check with you guys. Can you hear me all right?
Yes.
Wonderful, thank you. All right, so I told you that at the center of accounting is transactions. Transactions are the subject matter of accounting. If there are no transactions, there would be no accounting, no need to do any bookkeeping, prepare any financial statements, because we have no transactions. So we start with transactions, and a construction manager will of course be at the center of many significant, big, influential transactions, like hiring labor, purchasing equipment, purchasing land, clearing land, land development, then purchasing raw materials, which would be huge, could be huge in the millions of dollars, depending on the size of the project. So we'll always have transactions. And then we pay taxes, we have mortgages, we have loans, we pay regular installments. So there will be transactions. Now, this session is about how transactions are processed into financial statements, into the accounting system that allows us to prepare financial statements. All right, so I start with the transaction, and the transaction is, say, one of you, Ms. Williams, starts her construction business with just a small amount of money, say $5 million or say $5,000. It doesn't matter. We can keep the amounts as small as possible. So that's your transaction. And a transaction means any event that affects your financial condition. So remember that too, because the definition of transactions is as important as the analysis of transactions. So a transaction is an economic event. We say economic because it has to have a financial impact on your affairs, on the affairs of the company. So anything that changes your financial condition, anything that makes you richer, makes you poorer, anything that changes your composition of assets or composition of liabilities, or even the volume of assets or volume of liabilities, is a transaction. So I start with this, and this is usually the very first transaction of a business that Karim, so I use my name. Karim starts a business.
What was the definition of transaction again, Karim?
The definition of transaction is that it is an event. Transactions are events that affect your financial condition. So let's give some examples of events that affect your financial condition. Let's say if I buy coffee, and pay for it, well, when I say I buy, even if I don't pay for it, if I promise to pay for it later, it is a transaction because it is affecting my financial condition. Let's say I have $10, then I stop by Starbucks or one of these gas stations and purchase a coffee, a mug of coffee. So I pay, depending on where you buy it from, you pay, say, $4.80. Now, you can see as soon as you bought the coffee, you don't have your $10 anymore. So you have a consumable, you have a glass of coffee or mug of coffee that we call an expense, a miscellaneous expense or sustenance expense or conveyance or entertainment if you're buying it for someone else. So we have an expense here, a recognized expense for $4.80, and we also have less money if we pay for it. So that's a transaction. But the COVID test that my mother and I just had done is not a transaction, although it's an event. You know why it's not a transaction? Because they do it free. You just have to have, they ask for a photo ID and insurance. But even if you don't have insurance, they don't refuse you. And as a matter of fact, I discovered that even if you don't have a photo ID, they still would test you. So great people. I'd say the system is very good. All right, so because it has not affected my financial condition, I still have the same amount of money as I had before I went for the test. So it is not a transaction. My accountant has nothing to record. But if I went to a private place, say an urgent care, and paid for it, then that would be a transaction. Would debit medical expense and credit cash. And if we didn't pay for it, then we'd debit medical expense and credit accounts payable. Accounts payable because it has created a liability. It has increased my liability if I had any. All right, so free, when you get free stuff, then it is not a transaction. But when you distribute free stuff, that's an important thing. When you give away free stuff, then that is a transaction. Because you gave away free stuff free doesn't mean that it came to you free. So you bought it, or you manufactured it, or you created it. You see my point? Could someone respond? Do you see my point? That receiving free stuff is not a transaction, but giving away free stuff is one. But if you receive big donations, like big items, if you receive a television, if you receive a computer for free, then that is a transaction. Accounting records it as some increase in asset and increase in sometimes income, because even if we didn't pay for it, but it's an income. So for small items like having a free COVID test or having some free lunch, although we know that nothing is free, is not a transaction. So can you differentiate between transactions and non-transaction events? All of them are events. Transactions are events. Non-transactions or non-accounting transactions are also events. So the best way to define a transaction is that a transaction is an economic event. It is an economic event. It has affected your economic condition. All right. So we start a business with $5,000 of capital. of $5,000 of cash. Now, this transaction needs to be analyzed in terms of its effects on assets, liabilities, and equity. You remember that we had three elements of accounting, of the accounting equation. The equation was assets equals liabilities plus owner's equity. That means at any point in time, your assets would be equal to the total of your liabilities and equity. So after I start my business with $5,000, my equity has gone up by $5,000. My equity was zero because it's the very first transaction of our business. Before it, there was no business. Nothing existed. So now we have $5,000 of cash as well as $5,000 of equity. So it is the business who has the cash, not me. I invested $5,000 into my business. So there is a separation between me and my business. You got to take that into account, that we believe in a concept called business entity concept. So I'm digressing a bit. Business entity concept means a business is separate from its owner or owners or from any other business that you might have. So if you recognize or register it or incorporate it as an independent business, as a business, then it has to be, at least for accounting purposes, it has to be treated as a separate entity. So when I put $5,000 into a bank account in the name of the business, then the business now has $5,000. It didn't have anything until now, until I invested $5,000, but now it does. It has $5,000 of cash, and that cash is an asset, so its assets increased by $5,000, and owner's claim in the business has gone up by $5,000 or is created by $5,000. So owner's equity, remember, owner's equity into the business means owner's claim in the business. So business itself, business actually has to deal with the owners and creditors and customers. So owners are also a group of people who create sometimes pressure, sometimes expectations, or who are like, tantrum babies sometimes. Why? Because you invested $5,000, and as soon as you invested $5,000, now you look at the business and you say, yeah, you owe me $5,000. I have a claim of $5,000 in my business. My stake in my business is worth $5,000. Do you see my point? Guys? Are you okay up to this point?
Yes, sir.
All right. So we have an increase of $5,000 in our assets. So assets went up. Assets up by $5,000, and owner's equity is also up by $5,000. So I'm holding this onto this camera so that you can see it or you can read it. I think it is recording it as inverted images. So I'm not sure if it would be proper recording, but this is how we analyze. We have to analyze businesses, analyze transactions. Look at its effect in terms of changes in three things: changes in assets, liabilities, or owner's equity. So $5,000 of assets gone up and $5,000 of equity has gone up. Now remember, in our last meeting, we said you have to memorize at least one thing, one sentence. Everything else is logical, nothing to memorize. But if you can memorize a thing, the one thing, that should be this: assets going up is debit. Say again, say with me, assets going up is debit. If assets going up was debit, then assets going down would be what? What? Assets going up is debit, assets going down should be credit, opposite. You see it? Please respond, some of you.
Yes, sir.
Wonderful. Oh, what's your name so that I can talk to you over the course of the next few minutes?
Antonio. But Mr. Kareem,
Yes, please.
should we be able to see what you're writing down? The camera's blank.
Yeah, the camera there is
Yeah,
blank,
that's what I'm.
but I'm recording it on
Are
Zoom.
are you showing a screen or whatnot or something?
I'm recording this session on Zoom, and I will upload it onto our course website, Courses Blackboard.
Okay, so we just hearing your voice right now, huh?
Yeah, right now it's audio. Right now you're joining me on audio as if my camera is turned off. You know, like your cameras are turned off sometimes.
Okay.
Yes.
Okay, so as long as I can talk to at least one or two of you. So you said your name again, please. Simone?
Antonio.
Antonio?
Santonio, yes, sir.
No, Santonio.
Yes.
Okay, Santonio would be one of my teaching assistants tonight, or teaching associates. And may I have one of the guys, please, who was speaking?
Braxton.
Second, please.
Hello. Braxton.
Braxton.
Yeah.
Okay. Braxton. Okay, stay in touch. So if we now convert this transaction into a journal, we have seen that our asset has gone up. Our means businesses. Businesses asset has gone up. The asset's name was cash. So we said asset going up was debit. Therefore, we have to debit cash. So cash is debited
Dr.
here.
Kareem,
Yes, please.
I think we're asking, are you writing something down?
Yes, yeah, I am, yeah.
We can't see it.
Yeah, you cannot, but I will show what I write on this camera. It's going to be recorded, and then I will also take a picture of what I'm writing, and then we have a scanner, like a so-called Genius Scan, and I will upload those as PDF files onto the onto our Blackboard page.
Okay, I understand.
So this is what I wrote now: debit cash for $5,000 and credit capital $5,000. Well, you can actually, you can follow me and write things down yourselves. What I wrote now is a journal entry, simply 2 lines. On the first line, say debit cash, DR, debit cash, $5,000, and just below that, with a tab, write credit CR, capital $5,000. So that's our journal: cash debit and capital credit. That's our first journal. Okay. Let's do one more journal, at least one more, and then we'll learn how to do posting. So what do you do when you start a business with $5,000? What's the next thing that a construction project or a construction manager, engineer wants to do, typically does? What do they do?
Say that again.
Like, give me an example. Give me an example of a transaction after you start your business with $5,000 or $5 million. What would be a next transaction? What would be a next thing that you would like to do or you normally do? Say you buy.
We need to get licensing.
Okay, let's do some licensing. Perfect. Yeah. So let's apply for a license, and with the application, let's say we make a deposit of $150. Government fee. Does it make sense? So we go for licensing. We apply for license, for trade license, and spend $150. Okay, so that's transaction number 2. Apply for trade license, and pay the fees, pay $150 fees. So now, Braxton, you tell me, with this payment of $150, is any of my assets affected? Like, does it affect any of my assets? Do I have as much cash as I used to have?
You said $150 and
I spent $150 to apply for a trade license. So now, do I still have my $5,000 or I have any less?
it was minus because you
have
used
less.
it to, yeah, you use it to buy the license.
Yeah. So in terms of cash, do I still have my $5,000 or I have any less money? Obviously, I have $150 less, don't I?
Yeah, so you got less money.
I do. Yeah, so I have less money. That means my cash has gone down. That's what I wanted to hear. My cash balance, well, I mean, I spent the money on a good cause. I have no regrets. But my cash balance has gone down, hasn't it?
Yes, sir.
Okay, so assets going up was debit. Now assets going down should be what?
Credit.
Credit. That's it. Assets going up was debit. Therefore, assets going down should be credit. So I have got my credit. I have my credit. Now I need a debit now. So credit cash, $150. Now debit would be the expense, the licensing expense, the purpose of spending the $150. So when you spend money on things that are necessary for the business, and when you spend those on a recurring basis, like you could spend money on a long-term asset or a short-term expense. You see, I could spend money on purchasing a house. At the same time, I could also spend money on doing carpet cleaning. So if I spend money on carpet cleaning, we call it an expense. If I spend money on buying a carpet, then we call it an asset. So here, the licensing is an expense. I'd call it an expense. Okay? So we call it licensing expense or legal expense. Or miscellaneous expense. Debit and cash was credit. So I have my second journal. I have another journal now. This is my journal number 2. So I'll stop here and I'll now show you the ledger. So ledger is when you post a transaction onto the corresponding accounts. Corresponding accounts mean that a journal will involve at least 2 accounts. Santonio, how many accounts I said? It would affect at least
2.
2, because unless there are 2 parties, you cannot have a transaction. Remember It Takes Two, that movie of the 2 sisters? You remember the Olsons? You guys must have been.
The Olsen twin, yeah.
Yeah. Remember the Olsons? So there was a movie that It Takes Two, I think. All right, so those 2 sisters. All right, so it takes 2 to have a transaction. Or they say it takes 2 to you complete?
Tango.
Yes, yeah, that is it. It takes 2 to tango. So it takes 2 to have a transaction. I cannot have a transaction with myself. Okay, I can self-teach me all day. I can clean my house all day. I can do my dishes all day. I can cook my food, but it is not a transaction. Accounting is very mean. When you spend money on yourself, when you spend resources on yourself, it is not a transaction. But when you spend money, like when you buy clothes, then that's a transaction because your assets, one asset has gone up, another asset has gone down. But if you say I spend money on, you go to gym and you do workouts, no transaction. Okay, because expensing on yourself is like if you pay yourself, then you are no richer. You see my point? My point is, if I teach myself and then pay me, then I'm no richer nor poorer. But if I pay me $40 for tonight's accounting class, then it will be my money that I'm going to use to pay myself. So my money would go down on the one hand, and it would go up on the other. So I'd be as good. My financial status wouldn't change. In other words, my status quo would be maintained. All right, so now let's come to ledger. Ledger is where you post the transaction onto the corresponding accounts. So we had two transactions here. One was Karim started a business with $5,000. So in that first transaction, we had two accounts. My first account was cash and second was capital. Debit cash, credit capital. So I need a cash account. So I'm going to create a cash account now, which is a simple T account. So it is my cash account. See, just a T account, cash. I need another account called capital. My second account is my capital account. So let's do the posting. And now this is the point where you need to pay attention, very good attention. You just read your journal out, look at your journal. The journal says debit cash, credit capital. So I go to cash account first. All depends on what's written in the journals. Your journal says debit cash. So I go to cash account. Here's the cash account and capital account. So I go to cash, and then cash account has two sides here, like a T-junction. It has the debit side and the credit side. Now, which side do I go to? That depends on what's written here. What's written here, so you can see debit cash. It says cash should be debit. So I go to the debit side. I go to the, see here? I go to the debit side of cash account and post it. So go to the debit side of the account, put the date, which is September the 2nd, and enter the counterparty's name, like enter the other account name, other account title. So the journal was debit cash, credit capital. So cash's counterparty was capital. So we write September the 2nd, and we say capital. How much? $5,000. Then I go to the other account of the journal. The other account is capital account. So I go to capital account and I go to the credit side because the journal says credit capital. So I go to the credit side, enter the date, September the 2nd, and enter the counterparty's name. The counterparty is cash here. So you go to cash account and go to the debit side, enter capital, 5,000. Then go to capital account, to its credit side, enter cash for $5,000. So that's your posting. So that transaction is already posted here. Journal entry number 1 has been posted. You can see it has been posted. All right. Okay, now second journal entry. Our second journal was that we applied for a trade license. What did we do? We applied for a trade license. So our debit was licensing expense and credit was cash. So let's go to licensing expense, which should be a new account. So we create a new one. New T account. Called licensing expense. Go to its debit side. Because licensing expense was debited, go to the debit side and put the date first. So September the 2nd, and enter the counterparty's name, which is cash of 150. Then go to the next account, which is cash. The journal entry has the accounts licensing expense and cash. So I finished posting to licensing expense, and now I have to do the posting for cash. So I go to cash account, but this time I go to the credit side of cash account because cash was credited. You can see cash has been credited here. So we enter today's date again and enter licensing expense. The amount is 150. So this is our cash account so far. This is our capital account. This is our licensing expense account. So we have 3 accounts and 2 journal entries. 2 journal entries posted to 3 different accounts. So this is how you do the posting from journal to the ledger. Read the journal entry, look at the accounts, go to that account, go to the side that it tells you to. So if it's debit cash, then go to debit side of cash. If it's debit salary expense, then go to debit side of salary expense. If it's says credit cash, then go to the credit side of cash. But do go there. Once you're there, onto the right side, like the correct side, left or right, then enter the date and enter the counterparty account title. All right, so do you want to do one more journal? Let's do a third journal, and that journal could be, we now have applied for licensing, and then on the way back, let's buy some supplies for the business. We started a new business, so we'd like to have some markers, have some paper, have some supplies. Does it make sense, Santonio? Purchasing some supplies.
Yes, sir. Makes sense.
So let's purchase some supplies for, say, $50. So that's my third transaction. Buy supplies for $50. So this time our cash has gone up or down again. Tell me, if I purchase $50 worth of supplies and pay for it,
It went down.
it goes down. Yeah, so asset going down is debit or credit?
Credit.
Yes, you're a champion. So asset going down would be credit. So I do credit cash for $50, and an asset has gone up. When you purchase that much supplies and bring it home, you're not going to use all the supplies instantly. You know, supplies are not like coffee that it has to be consumed straight away. So supplies are going to be there unless you use it. So we call supplies an asset. Current asset though, it's not a long-term asset. It's a short-term asset, but it is an asset nevertheless. Okay, so supplies is an asset, and that asset has gone up. So we learned that assets going up was assets going up was what? Debit or credit? Debit.
Debit.
So assets going up was debit, and that asset is supplies. So I'm going to debit supplies for $50. So that's my third journal here. You can see I purchase supplies for $50 and debit supplies and credit cash. So I have a cash account, luckily, but I don't have a supplies account. So I need to create one. So we go and create a new ledger account. And that ledger is going to be called supplies. Supplies account. So now the posting. The journal has the 2 accounts. One is supplies, another is cash. So I have a cash account. I have supplies account. I now have supplies. So we go to the first account first. We go to supplies account. And we go to the debit side of supplies account. So I go here, come here, and I enter, say tomorrow's date, September the 3rd, and which account's title do I enter? Braxton. My journal was debit supplies, credit cash. So we told you that in a ledger account, never enter the account title, the original account title inside it. So if it's Braxton's account, within that account, I will not see Braxton's name because Braxton can never have a transaction with him. So you cannot have Braxton account debit and Braxton account credit. You cannot have supplies account debit and supplies account credit. Impossible. So I go to supplies account and I enter the counterparty's name. Remember, Braxton, are you there? Okay, Santonio, you tell me. Are you guys there? Can you hear me?
Yes, sir.
Okay.
We can hear you.
Okay, so
I can hear you.
okay, Braxton, yeah, inside an account, when you do the posting, like in my house, on the door, you'll see my name. But then once you are in it, you won't see my name. You see, like your room, for example, say my mother's room, and on the door, I enter, I put a name sign, I put a sign saying mother. That means it's mother's room. But inside that room, you'll see her stuff. You'll see her desk, you'll see her wardrobe, you'll see her bed, her stuff. Okay? So inside an account, we do not want to see the same account name. We want to see the counterparty's name. All the names with whom that account had transactions. So supplies account was debit and credit was cash. So I enter cash here. And that was for $50. And then I go to cash. I go back to cash account. And I go to credit side of cash because the journal said go to credit. So I put 9, the 3, September the 3rd. And I put supplies account for $50. So I'm going to stop here. And now I'll finish the balancing. And with these balances, we'll be in a position to show you a trial balance. And that'd be great. That would be great. So we already passed, we're already into like the fourth step of the accounting cycle. The first step was transactions analysis, like in terms of the accounting equation, how the transaction affected the elements of the accounting equation. Second was journal. Third is ledger. And once we finish ledger, we will be onto the fourth step of the accounting cycle. Now balancing. So how do you do balancing? Santonio, so listen to me here. Balancing is done in a way very simple. So you look at the, you try to look at the ledger. Try to look at the ledger and see the amounts on both sides. Add the two roughly, like privately, do the totals. So in my cash account, I can see $5,000 on the debit side and only $150.50. So $200 on the credit side. So my debit total is 5,000. So the bigger one you do first, or you enter it first. So I have $5,000 here as the total. But my right-hand side has only $200. How much? 200. One was the $150 of licensing expense, a licensing fee, and the other one was supplies. So I spent a total of $200. You know, I mean, we don't need accounting for that. Based on the transactions, based on the discussions we had in the last half an hour or so, we know that the company started off with $5,000, then they applied for licenses with $150, and now they bought supplies for $50. Okay, so that's all they had. So $200 is the total on the right-hand side. So $5,000 minus 200 gives you the cash balance. So on, say this is the end of September, so September 30th, assuming there was no other transactions during the whole month. We started our business, we applied for licensing, and we purchased some supplies, and we have been waiting for the license to be issued. And let's assume that nothing has been issued until the end of the month. So now I have $4,800 of cash balance. So we call it balance. In the cash account, it would mean cash balance. In other accounts, it would mean their balance. So now, with the $4,800 plug, the two sides are equal. See? $5,000 here, $5,000 there. So $5,000 has been received, $200 have been spent, and the remaining $4,800 are still there, cash on hand. So in the next step, like in the trial balance, we would be using only the balance. We don't need all the composition. We need only the final balance of every account, not just the cash account, of every account. So that's my cash account. I have a balance of $4,800, debit balance, because debit side was bigger. Now, capital account has no other transactions, only one transaction, which is my initial contribution into the business. So my balance here is the same $5,000. $5,000. And then come to my licensing expense. All it has is one item, 150. So that would be my balance, 150. Actually, if you have only a single item, then don't bother balancing, because that would be the balance, obvious balance. If I have just one book, then that's my stock of books. If I have two, then you have to add. All right, so I have done the balancing of 3 accounts and 1 to go. This one is supplies. Supplies account. Debit side, we have $50. Nothing on the credit side. So my balance is $50. That is my balance. Now we're going to prepare a trial balance, and in a minute or two, after having the trial balance, we're going to have a break, and I will see if the recording is working. I'll post it on our Blackboard page and see if it works. Well, so the trial balance. How do you do the trial balance? I have 3 accounts here and a 4th one here. So these are my 4 accounts. Cash account with a $4,800 balance, capital with $5,000, licensing expense with $150, and supplies with $50. So this is how a trial balance looks like. Let me show you on a fresh piece of paper. This is a trial balance. We'll have 3 columns only. So this is how it will look like. 3 columns. The extreme left column is account names. This would be debit money column. And the last one would be credit money column. Look at it. So simply list the accounts. So we have 4 so far. Our first one was cash with a balance of $4,800. That would be on the debit column because that was a debit balance. Why? And how do you know that it was a debit balance? It was a debit balance because the debit side was bigger. and the balance appears on the credit side. So if a balance appears on the credit side, then that means it was a debit balance. So cash was $4,800 debit. Second was capital. There was a credit balance of $5,000. Then you have licensing. Expense, which is a debit balance because debit side was bigger, $150. And supplies, which also has a debit balance of $50. Supplies had a debit balance because look at it, the debit side had that transaction and credit side had nothing, so we plugged it. We just use the balance as a plug, so supplies. So if you add these numbers, in other words, if you complete the transaction, you can have a total of debits and credits to check the arithmetics behind it. So $4,800, 150 and 50. So that makes it $5,000. And then the other side is also $5,000. So that's our trial balance. I've now entered all the accounts: cash on the debit side, capital on the credit side, owner's equity is credit, and then licensing expense are debits, and this is an asset called supplies. So that's a brief introduction, although I couldn't keep it brief. Introduction to journal and ledger postings up to the trial balance. All right, so to sum up what we've learned, or what I would expect you to learn from this last 40 minutes or so, is that you have to understand some parts of the accounting equation, of the accounting cycle. We give you a transaction, you analyze the transaction in terms of its effects on assets, liabilities, and owner's equity. So you analyze it based on those, and then you create your journal entries. So in the journal, you check your results. Has it affected any asset? And if it has the assets gone up? Has it gone up or came down? And again, if I see an increase in assets, then there will be debit. If I see an decrease in asset, there will be credit. So assets going up, debit; assets going down, credit; liabilities going up, credit; liabilities going down would be debit, and so is owner's equity. Going up is credit, going down is debit. So these two are on the right hand side of the equation, and assets are on the left hand side of the equation. All right, so we analyze transactions in terms of its effects on the elements of the accounting equation, and then we enter our journal entries. Journal entry would follow the rules, like if assets goes up, then debit. So when I introduced $5,000 into my business, my asset has gone up, cash balance. It had no, my little business had no cash. So now it does. So debit cash and credit capital, owner's capital. Then you spend money on licensing fees, so debit licensing expense or licensing fees, credit cash because cash has gone down. Then you purchase some supplies, debit supplies and credit cash. So we have these four accounts, and our balance, our trial balance does. Balance means the two sides are equal. So arithmetically we are correct. So I'll now take a break for a few minutes. And when we come back, we'll do another session of recording. Let me end this recording and see if it can be saved. I'm sure it can be, and if I can transfer it onto our Blackboard page. All right, thank you all for listening, and special thanks to Santonio and Braxton for your cooperation. All right, see you soon.